In 2001, Enron was named Most Innovative Company in America for the 6th year running. 6 weeks later, bankrupt. In 2018, a UK construction giant with 12,000 staff collapsed with £28 million in cash against $7 billion in liabilities. The auditors had signed it off months earlier. And in 2020, a German tech company on DAX 30 admitted that 1.9 billion euros of its cash didn't exist. Their auditor had been signing it off for 12 years. Hi, I'm Justyna from Practices Academy, and before I built PTA, I trained as an auditor, and I worked at KPMG. So when I tell you these stories, I'm not just reading the textbook. I actually sat in those rooms, I've signed working papers, and one of the 3 scandals that I'm about to talk you through actually happened on my old company's watch. So if you're studying for CIMA or ACCA, I want you to ask yourself one question before you watch this video. Would you have spotted? Because the auditors didn't, the regulators didn't, and the directors didn't. 3 scandals, 3 lessons, starting with Enron.
The Enron accounting scandal of 2001.
For 6 consecutive years, Fortune magazine named Enron America's most innovative company. The market lauded its sophisticated financial risk management and meteoric growth. And then, it abruptly collapsed into what was at the time the largest corporate bankruptcy in U.S. history.
Section 1. The Illusion of Innovation.
Enron Corporation was formed back in 1985 when Kenneth Lay merged 2 regional pipeline companies. Initially, it was an unremarkable interstate operator, but the transformative shift happened in the early 1990s. Under the intellectual direction of Jeffrey Skilling, Enron aggressively lobbied for deregulation, transitioning from a physical energy producer to a high-stakes trader of derivative contracts. By November 1999, they launched Enron Online, a platform that rapidly became the largest business website in the world.
The market entirely bought into this illusion. By the end of the year 2000, Enron stock reached $83.13. Its market capitalization exceeded $60 billion, trading at an astonishing 70 times earnings. Enron was now the 7th largest company on the Fortune 500.
Section 2. The Mechanics of Fraud. The absolute cornerstone of Enron's manipulation was the aggressive application of mark-to-market accounting. Championed by Skilling, this meant that the very moment a long-term contract was signed, Enron recorded the present value of projected future cash flows as current income. This happened long before a single cent was actually received. Because they systematically overstated these projections and obviously couldn't book the future profits twice, the company was forced onto a treadmill. They required constant, accelerating new deals just to maintain the illusion of rising income.
The sheer extent of this distortion was later laid bare in the Batson Report. For the year ending December 2000, Enron reported $3 billion in cash from operations. The actual figure? A negative $153.9 million. They reported $10.2 billion in debt, masking an actual burden of over $22 billion. The entire balance sheet was fundamentally compromised.
To maintain its credit rating amidst this crisis, Enron engineered hundreds of special purpose entities, or SPEs. Under U.S. GAAP rules at the time, an SPE could be legally excluded from a company's balance sheet, provided an independent outside investor owned at least 3% of the equity. Chief Financial Officer Andrew Fastow systematically exploited this 3% rule, creating a labyrinth of off-balance sheet structures.
Through these highly complex transactions, Enron successfully moved a staggering $14 billion of corporate debt entirely off its balance sheet, hiding its true peril from investors and regulators alike.
The most damaging of these structures were the Raptor SPEs. Designed to absorb Enron's mark-to-market losses, they had a fatal flaw. They were hedging Enron against falling asset values, using Enron's own stock as collateral. When Enron's stock price inevitably began to fall, the collateral underpinning the entire structure collapsed right along with it. The SPEs were, in effect, hedging with themselves.
The architecture of these entities relied on a severe conflict of interest. Andrew Fastow managed the LJM partnerships as general partner while simultaneously serving as Enron CFO. Fastow personally enriched himself by a staggering $45 million from his work with LJM, earning these vast sums by structuring deals that were explicitly designed to help Enron make its numbers look exactly the way it wanted them to look.
Section 3. The Internal Whistleblower. By mid-2001, Vice President of Corporate Development Sharon Watkins began investigating the LJM and Raptor structures. Realizing the entities were completely unhedged and relied entirely on Enron stock, she sent an anonymous, highly prescient memo to Kenneth Lay in August 2001. Her warning was explicit. She wrote, "I realize that we have to conduct a thorough review with outside counsels. We should bring any potential accounting issues to light before the company collapses in a wave of accounting scandals."
Kenneth Lay's response was to ignore the substance of the memo entirely. Instead, he routed the investigation back to Vincent Elkins, the very legal firm that had helped structure many of the deals in the first place. Unsurprisingly, this highly conflicted review concluded there were no problems, effectively burying Watkins' concerns.
Section 4. The Auditor's Complicity. Arthur Andersen, Enron's external auditor, failed to exercise professional skepticism. The core reason was economic dependency. In 2000, Andersen earned $25 million in audit fees and an additional $27 million in consulting fees. This systemic pressure to accommodate the client overrode their objective professional judgment.
This institutional failure extended to the highest levels. Carl Bass, a senior technical partner in Arthur Andersen's professional standards group, formally objected to the accounting treatment of the SPEs, noting they lacked genuine economic substance. Rather than heeding his warnings, Arthur Andersen removed Bass from the Enron audit team at the client's request, dismantling the firm's last internal line of defense. As the SEC upgraded its inquiry to a formal investigation in October 2001, lead audit partner David Duncan instructed his team to shred literally tons of audit documents and delete tens of thousands of emails. This deliberate destruction of evidence forced Arthur Andersen to surrender its CPA licenses, permanently destroying the historic firm.
Section 5. The Ethics Postmortem.
For those of you studying professional accounting, the actions of Enron and Andersen represent a total, systemic breakdown of the 5 fundamental principles of the ISBA Code. Integrity was violated through deceptive mark-to-market reporting. Objectivity was compromised by lucrative consulting fees. Professional competence and due care were abandoned when auditors ignored the reality of the SPEs. Confidentiality was abused for insider trading, and professional behavior was discarded entirely at the shredder.
The sheer scale of this institutional failure necessitated sweeping legislative reform. The Sarbanes-Oxley Act of 2002 was enacted, fundamentally altering the regulatory landscape. Crucially, it permanently prohibited audit firms from providing a range of non-audit and consulting services to their audit clients, legally mandating the structural independence that Arthur Andersen so disastrously lacked.
Enron did not merely fail due to market conditions. It was systematically engineered, at the highest levels, to hide the truth. As you move forward in your own careers, it leaves a vital question. When the numbers are specifically designed to deceive, will you have the professional skepticism to see the truth?
That was the scandal that killed one of the big 5 accounting firms. 28,000 Arthur Andersen employees worldwide gone. Enron is just the reason we got this. The so-called SOX passed within months after Enron collapse. New rules on auditors' independence, CEO and CFO must sign off on internal controls, mandatory audit firm rotation. Every auditor who's ever had to document a control walkthrough at 9 p.m. on Friday night knows exactly how I feel about it. The profession swore it would never happen again. So, fast forward another 20 years, new regulations, new rules, a completely different country, a completely different industry. Surely, we'd learned the lesson, right? Meet Wirecard.
On the 25th of June 2020, the German financial technology giant Wirecard became the first blue-chip DAX 30 company in history to file for insolvency.
The immediate catalyst for this unprecedented collapse was a stark, singular fact. 1.9 billion euros, representing roughly a quarter of the company's entire balance sheet, simply did not exist.
Part 1. Rise of a FinTech Giant.
To understand the sheer scale of this illusion,
we have to look at the origins of what was once considered Germany's premier technological champion. Founded in a Munich suburb back in 1999, Wirecard started out as a relatively small online payments processor. At the time, their client base was almost exclusively merchants in high-risk categories. Think adult entertainment and online gambling, sectors that mainstream card networks usually rejected. Then, in 2002, Markus Braun stepped in as CEO and completely pivoted the firm towards aggressive international expansion. Now their core legitimate business was pretty straightforward, acting as an intermediary between retailers, consumers, and banks to process electronic payments. But a massive turning point hit in 2006 when Wirecard acquired Excombank. This gave them a full German banking license, meaning they could manage deposits and issue cards directly, creating a highly complex hybrid of a banking and non-banking business. Under Braun's leadership, the valuation just absolutely skyrocketed. By September 2018, Wirecard actually replaced Commerzbank on the prestigious DAX 30 index, hitting a peak market capitalization of over 24 billion euros.
Part 2. The Financial Times investigation. Yet behind that soaring market valuation, the external cracks in Wirecard's corporate facade were already starting to show. Starting around 2015, Financial Times investigative reporter Dan McCrum began heavily scrutinizing Wirecard's acquisition of some rather obscure Asian businesses. He noticed a bizarre pattern of complex, suspicious money flows. Things escalated dramatically in 2018. The legal team over at Wirecard's Singapore office actually kicked off an internal investigation after a whistleblower flagged illegal money flows. That same whistleblower ended up handing the Financial Times 70 gigabytes of internal data and thousands of emails, and these leaked documents were damning. They revealed that senior accounting staff in the Asia-Pacific region were actively forging and backdating contracts. The internal communications explicitly documented findings of serious offenses of forgery and falsification of accounts and documents.
Now, when the FT published these factual allegations, you might think Wirecard would initiate genuine internal reform. They didn't. Instead, the company deployed highly aggressive corporate deflection tactics purely designed to intimidate their critics. They issued blanket denials, they sued the journalists, they even commissioned private detectives to surveil reporters and investors right at their homes. A coordinated hacking campaign targeted the journalists' personal electronics, and incredibly, Wirecard executives, working with an Indian hacker team, fabricated a fake whistleblower dossier known as the Zatara leaks. The goal there was to falsely suggest the Financial Times was illegally colluding with short sellers to manipulate the market.
Part 3. Anatomy of the fraud. All this intimidation temporarily masked the mechanical reality of the deception. Because at its core, the Wirecard scandal was a highly sophisticated accounting fraud layered perfectly on top of its legitimate operations. The whole mechanism hinged on a concept called third-party acquiring, or TPA. In jurisdictions across Asia and the Middle East, where Wirecard didn't have its own banking licenses or infrastructure, it claimed to partner with local payment processing companies. These third-party acquirers were supposedly handling local merchant transactions on Wirecard's behalf, paying Wirecard a commission, and then holding the resulting funds in escrow accounts as security. For those unfamiliar, escrow accounts are specialized third-party trust accounts designed to hold funds safely until specific contractual conditions are met. Now, third-party acquiring is a perfectly legitimate business model, but Wirecard completely exploited it. Between 2016 and 2018, according to a later special audit, about half of Wirecard's total revenue and the vast majority of its global profits were attributed to this incredibly opaque outsourced network.
The precise mechanics of the deception were actually pretty clinical. Wirecard engaged in round-tripping. They moved money from their German bank to subsidiaries, routed it through external customers, and then brought it right back as supposed revenue to artificially inflate their profits. And to validate these inflated revenues to the outside world, the companies simply forged bank confirmations. The absolute peak of this scheme was the wild assertion that 1.9 billion euros of the supposed profit was sitting safely in escrow accounts held in 2 banks over in the Philippines.
But the physical reality of these operations was completely disconnected from the financial statements. When journalists physically traveled to locate these massive Asian profit hubs that were supposedly generating hundreds of millions of euros, they found absolutely no corporate offices. Instead, they found quiet suburban houses. In one frankly astonishing instance, a registered hub was just a family home operating a local transport business. The entire illusion finally shattered in April 2020. Under massive market pressure, Wirecard's supervisory board commissioned a special forensic audit by KPMG. The resulting report was devastating. KPMG concluded that they simply could not verify the existence of the supposed third-party profits, nor the cash balances.
Part 4.
The auditor's failure.
The fact that a multi-billion-euro deception persisted for over a decade raises a huge question about the catastrophic breakdown of institutional oversight. Ernst & Young, or EY, had served as Wirecard's auditor since 2008, issuing unqualified audit opinions year after year. The fundamental failure at the very heart of this audit relationship was a blatant breach of standard independent confirmation procedures. For years, EY failed to directly and independently verify the cash reserves with the foreign banks in Asia that supposedly held Wirecard's funds. Instead of executing the most basic audit procedure, requesting direct independent statements from the banks themselves, the auditors relied on documents, spreadsheets, and screenshots provided by a third-party trustee and by Wirecard management itself. Documents which, as we know, were ultimately forged.
Part 5. The Regulator's Blind Spot. This failure of oversight extended way beyond the external auditors, exposing a massive, systemic failure within the German state regulatory apparatus itself. The Federal Financial Supervisory Authority, better known as BaFin, is mandated to investigate corporate fraud and protect market integrity. Yet, as the mountain of evidence against Wirecard grew, BaFin's actions actively protected the company. Early in 2019, right after the Financial Times published that whistleblower evidence of fraud, BaFin responded by banning the short selling of Wirecard stock. Even more astonishingly, in April 2020, BaFin filed criminal complaints against the journalists and the short sellers for market manipulation. The regulatory body aggressively pursued the exact people attempting to expose the fraud, all to defend what they perceived as a national technological champion, completely blinding themselves to the corporate deception right in front of them. Naturally, this catastrophic regulatory blind spot drew immediate, harsh scrutiny from the European Commission and the European Securities and Markets Authority. The resulting fallout forced a complete, top-to-bottom overhaul of the German regulatory framework. The government was compelled to introduce the Financial Market Integrity Strengthening Act. This was designed to grant BaFin far greater investigative powers, mandate auditor rotation, and fundamentally restructure how the state supervises large corporate entities.
Part 6. The Ethics Lesson. For accounting professionals, the collapse of Wirecard is a profound, real-world study in the consequences of ethical failure. The actions of management, auditors, and regulators map directly onto severe breaches of the fundamental principles of the ISBA Code of Ethics. We see a catastrophic failure of integrity and objectivity among the corporate officers who orchestrated the round-tripping and fabricated the revenues. The failure of the auditors to directly verify cash balances represents a severe breach of professional competence and due care. But above all else, the Wirecard scandal highlights a fatal systemic absence of professional skepticism. Both the auditors and the regulators accepted management representations completely at face value, casually ignoring glaring inconsistencies, mathematical impossibilities, and highly credible whistleblower reports.
And the consequences of these ethical and professional breaches are severe, very real, and ongoing today. While the highly complex criminal trial of former CEO Marcus Brown continues in Munich, convictions are actively being secured internationally. As recently as January 2026, the Singapore courts handed down continuing prison sentences to businessmen involved in falsifying the documents that supported the entire Wirecard deception.
This was a multi-billion-euro fraud executed by a DAX 30 blue-chip company. This did not happen back in 2001 during the early, Wild West days of corporate governance. This happened right now, in our modern, heavily regulated era. The lessons of Enron did not prevent Wirecard.
That one wasn't 2001, that was 2020. The lessons from Enron didn't prevent Wirecard. Now, the next one is the one I have to tell you about personally. I traded KPMG between 2004 and 2006, so it was long before Carillion contracts were investigated by FRC. But it's still the same firm, the same training, the same culture. And what you are going to see is that auditors were signing off accounts 6 weeks before the audit work even finished, on company holding £29 million against £7 billion in liabilities. Honestly, I have thoughts. And if you are going to see the audit paper, or if you're going to work in audit one day, please pay close attention to this one. Because this isn't the dramatic, novel kind of fraud. This is the comfortable kind. The kind that grows from not asking the next question. This is Carillion.
£29 million in cash. That was the reality. Against nearly £7 billion in total liabilities. When the Carillion Group entered compulsory liquidation in January 2018, The financial reality shocked the British state.
The complete deterioration of what was once a monolithic corporate entity didn't just happen overnight. It happened methodically, deliberately, and right in plain sight.
Section 1. The setup. Understanding the scale of Carillion.
Carillion wasn't simply a construction firm. It was critical British infrastructure. They maintained approximately half of the UK's prisons, managed the smart motorways traffic control system, supplied school dinners, and provided extensive facilities management for NHS hospitals and Ministry of Defence sites. Employing 12,000 staff in the UK alone and tens of thousands more globally, Carillion was one of the government's most significant private sector partners. Their operations were completely integrated into the daily functioning of the state. For accounting and finance professionals, understanding this sheer operational scale is vital to grasping how the concept of going concern was so aggressively stretched.
Section 2. The collapse timeline.
The public unraveling of Carillion was brutally fast. On the 10th of July 2017, the company issued a shock profit warning, announcing an £845 million provision for problem contracts. That single announcement effectively obliterated 6 years' worth of reported profits in a single day. The market reaction was instantaneous, but the bleeding had only just begun. Cascading profit warnings followed throughout the autumn of 2017, as the true, toxic state of the balance sheet became impossible to hide. By the 15th of January 2018, after banks finally refused further financial support and the government declined to guarantee fresh funding, Carillion was forced into compulsory liquidation.
The fallout was immediate, wide-ranging, and severe. Essential public services faced sudden disruption, requiring an emergency £150 million commitment of taxpayers' money just to keep hospital doors open and school meals served. Across the supply chain, subcontractors and suppliers were left completely exposed, owed an estimated £2 billion that would never materialize. Furthermore, the company left behind a reported pension deficit of £590 million, exposing tens of thousands of dedicated pension scheme members to severe, lifelong financial risk.
Section 3. The accounting issues.
The collapse was fundamentally driven by aggressive accounting practices, the exact mechanisms you're trained to identify and regulate.
The primary systemic issue here involved construction contract revenue recognition under IFRS 15 and its predecessor, IAS 11. As you know, construction accounting relies heavily on management estimates of the final outcome of a project. Well, Carillion systematically exploited this. They recognized revenue and profits on highly complex, multi-year construction projects, like the Royal Liverpool Hospital, long before the actual outcomes of those contracts were certain. Management aggressively traded future claims, meaning expected recoveries from clients for delays or design changes, as guaranteed revenue. This approach artificially inflated both reported revenue and the value of contract assets on the balance sheet, presenting a total mirage of consistent profitability on materially loss-making projects.
To mask the immense cash shortfall created by this phantom paper profit, Carillion relied heavily on reverse factoring, also known as supply chain finance. Under this arrangement, a financial institution paid Carillion's suppliers early, at a discount. Carillion then repaid the financial institution much later, forcing its own suppliers onto punitive 120-day payment terms. The accounting distortion here is the critical part. Carillion classified the outstanding amount owed to the financial institution as trade creditors rather than short-term borrowings. When they finally paid the banks, they included this as an operating cash flow rather than a financing cash flow. In 2016, this exact classification sleight of hand artificially flattered their operating cash flow by £200 million. Without this financing flow disguised as an operating flow, the company's operating cash flow would actually have been a negative £85 million.
These distortions fed perilous going concern assumptions. Management maintained £1.57 billion in unimpaired goodwill on the balance sheet, despite rapidly deteriorating cash generation. They pushed relentless, unjustified dividend payouts, distributing over £550 million between 2009 and 2016, while the company was effectively being hollowed out. Concurrently, systemic pension accounting failures persisted. Despite massive looming liabilities, former finance director Richard Adam explicitly treated vital pension deficit contributions as a waste of money, heavily prioritizing short-term shareholder distributions over long-term solvency.
Section 4. The auditor's role. For 19 years, right from its inception in 1999, Carillion was audited by KPMG.
A massive 5.5-year investigation by the Financial Reporting Council into the audits between 2014 and 2017 uncovered severe structural deficiencies.
The FRC found that the audit team, led by engagement partner Peter Meehan, systematically failed to challenge management. Most shockingly, the investigation revealed that audit reports for the crucial 2016 financial year were occasionally signed off up to 6 weeks before all the required audit work was actually complete. The resulting regulatory action was historic. The FRC imposed an initial £30 million fine on KPMG, which was later reduced to £21 million due to the firm's cooperation. Still, this was the largest fine ever issued by the FRC at the time. The consequences for those directly involved were absolute. Peter Meehan faced severe personal financial sanctions and was formally excluded from the profession for 10 years. For a senior partner, this didn't just end a career, it completely erased a professional legacy. The core of the FRC's findings highlighted a systemic breakdown of fundamental auditing principles. The regulator stated explicitly that KPMG failed to conduct its audit work with an adequate degree of professional skepticism. Instead of consistently challenging management's highly optimistic representations regarding aggressive revenue recognition and massive unjustified goodwill balances, the auditor accepted the presentation of financial information that suited Carillion's directors. They fundamentally failed to act as the independent gatekeeper the market required. The collapse triggered severe parliamentary scrutiny. During a joint committee hearing investigating the fallout, the total failure of the audit function was summarized in a devastating exchange. Labor MP Peter Kyle, questioning a KPMG audit partner who struggled to confirm basic contract flow figures, delivered this brutal assessment. "I wouldn't hire you to do an audit of the contents of my fridge, because when I read it, I wouldn't actually know what is in my fridge or not." Section 5. The Ethics Lesson. For anyone studying for their professional qualifications, the Carillion collapse serves as a definitive case study. The documented failures in this case map directly to the 5 fundamental principles of the ISBA Code. Professional competence and due care were breached by the audit team failing to gather sufficient appropriate audit evidence on the reality of going concern and revenue recognition. Objectivity was fundamentally compromised by a highly lucrative 19-year relationship where Carillion was a crucial client, creating an undeniable risk of bias and a reluctance to challenge senior management. Integrity was violated when audit reports were signed prematurely and when corporate management recklessly withheld the knowledge of severe financial deterioration from the public markets. Finally, confidentiality and professional behavior were structurally undermined throughout the process, resulting in conduct that ultimately discredited the entire accounting profession on a national scale. This systemic failure directly triggered major UK audit reform proposals. The government commissioned the Kingman Review, which recommended the total abolition and replacement of the Financial Reporting Council, alongside the Bryden Review, which called for a fundamental reevaluation of the purpose of audit and demanded far greater obligations around fraud detection and forward-looking financial viability. Professional skepticism under ISA standards is a substantive obligation, not a procedural formality.
3 scandals in 3 decades. Enron 2001, Wirecard in 2020, and Carillion in 2018. And every single one of them violated the same 5 fundamental principles of ISBA Code of Ethics. Integrity, gone the moment the CFO signs off something he knows isn't true. Objectivity, gone the moment an audit team can't afford to lose the client. Professional competence and due care, gone the moment we'll check that next quarter becomes the working answer. Confidentiality, abused every time inside knowledge becomes inside trading. And professional behavior, discarded entirely, somewhere between the shredded and fake bank confirmations and the audit signed off before the work was done. Here's what you need to take away from this, especially if you are studying for CIMA or ACCA right now. When I trained in audit, Sarbanes-Oxley was new. We thought it had fixed the problems that Enron exposed. Then Wirecard happened and Carillion. And we have to be honest with ourselves about something. Ethics is not a chapter in our textbooks. It's not just easy marks at the end of the question. It is the entire profession. In your exams, whether it's CIMA, OCS, MCS, SCS, or ACCA ethics questions, when you get an ethical dilemma, it's not just being tested on whether you know the principles. You're being tested whether you actually apply them. When the pressure is on, when the client is paying, when nobody else is in the room, but basically asking the right questions. Because the auditor said KPMG Ernst & Young and Arthur Andersen, they all knew the principles. They just didn't apply them. If you want to practice the kind of ethical scenarios that come up in the real CIMA and ACCA questions, head over to Practices Academy, link in the description. And if you want to cover more scandals like Patisserie Valerie, WorldCom, Tesco, Steinhoff, drop a comment below and tell me which one. I will include in the video if I make that part 2. I'm Justyna, thanks for watching, and keep asking the right questions.